Good afternoon, everybody. My name is Sean van den Berg. I head up client education at PhD Online. Welcome to our webinar presentation for today. We're going to cover exchange traded products. Any questions you guys have? I'm riding solo today. I don't have a panelist with me, so please send the questions through. I'll try and answer them at the end of the presentation. If not, I'll also come back to you by email. But here's the agenda for today. And by the way, those of you that are listening, make sure that your settings on mic and speakers, then you'll be able to hear me. So here's the agenda for today. We're going to discuss what are exchange traded products. It's the umbrella for exchange traded funds and exchange traded notes. So now I'll highlight the two options of going into these products, either obviously through a PhD Online equity account or through an investment plan. So I also want to highlight the advantages and disadvantages of this financial product, and also go through the process of how to choose an ETF or ETN. I think that's what a lot of people stumble on, and just the suggested investment strategy. So that's what we're going to discuss in the next 45 minutes or so. So any questions? Send them through, type them through on the panel here, and then I'll pick it up at the end of the presentation. Okay, so let's move forward. As I said just now, exchange traded products can be considered as an umbrella. You can say it's a umbrella for investment vehicles. It's very similar to your unit trusts in the sense that they derive their prices from other instruments. The big difference between exchange traded products and unit trusts is that the ETP, its price is determined intraday. So that also gives you that flexibility. But exchange traded funds as such were first launched here in South Africa in 2000, where the first ETN was launched in 2010, 10 years later. They're still very, very new on the market, but the whole idea is that they replicate the performance of a specific index and prescribed to investment mandate. So similar to unit trust, they are open-ended investment vehicles in the sense that a fund can issue more shares or buy back the units. So these funds are traded, are listed on listed securities, and they obviously trade on exchanges. So the SATX 40, which was the very first one to be listed, you can imagine it's like a unit trust. It pulls investors' funds. And the big advantage and attraction there is that it's a very cost-effective instrument. Gives you the investor the access to a large basket of underlying shares just through one share. So you gain exposure to the best performing, the 40 performing shares on the market if you're looking at the top 40, the SATX 40 rather. Then except for New Gold, all the other ETFs are considered what they call collective investment schemes. And obviously they're bound by regulations governing investment products. So obviously there's a lot of regulations around these products as such. So as I said, there's two ways to get into exchange traded products. You can either go open up an account with a stockbroker and trade these ETPs as a normal share. Obviously there's a difference with costs. Going the equity account route, obviously, is for the person who's got a bigger lump sum to invest, whereas the PhD Online investment plan is someone that's looking at a debit order. We remember on the equity account you can't have a debit order, so it's someone you can put a minimum of 300 Rand a month away. I personally use it for my daughter's education, my children's education, so I'm using it as a long-term product. You can also obviously invest lump sums into the investment plan. So let's talk about the requirements. So say you can have a once-off investment, and the minimum investment there is 1,000 Rand. So it is affordable for most people. Alternatively, you can use the debit order option, and there the minimum is 300 Rand per month per fund. Okay. So that is the investment plan. We're looking at the costs. There are certain costs involved with the investment plan. There's an annual fee which excludes VAT, which is 1%. That's the total value of your portfolio. Now that 1% obviously is divided by 365 days, and that, rather by 12, and that is debited to your account on a monthly basis. Every debit order you have will be charged $350. There's a trading fee of 0.1% excluding VAT. Insider protection levy, similar like what we got with shares, obviously levied on all transactions. However, there is no securities transfer tax levied on ETFs. Okay, they are seen as collective investment schemes, and hence there's no STT. Remember, with normal shares, 0.25% of your exposure, that's a government levy, a form of tax that you pay. So with ETPs, that's one of the advantages. When it comes to the investment plan, with regards to the settlement fee, there's a $12.45 settlement fee. This is what they call the straight settlement fee. It's charged on all trades per fund per day. Now, with the investment plan, just understand that the fee is split between the pool of investors who have submitted investment instructions for that particular fund on that day. So if you're the only person to have bought that particular ETF that day, you have to pay the $12.45. If it's a pool, obviously it's divided proportionally. Now, this is all in the terms and conditions when you sign up with investment plan. Just understand that the settlement fee, obviously, is pooled. Alternatively, you pay for all of it. Let's talk about some of the advantages. The main advantage is obviously diversification. You've got a wide range of products to go into that obviously track either domestic or foreign equity indices. There's commodity-based ETFs and ETNs. There's property. There's various styles. We will go through them just now, style and fundamental ETFs. So it caters for a whole range of investors' choice as such. Obviously, with liquidity, they're actively traded, especially the ETFs, and obviously that ensures liquidity. You can access these ETPs and ETFs either, as I say, through the PSG Online trading platform or through the investment plan. So you've got flexibility. You've got actually up to 9 different providers of ETPs on the one platform to choose from. So they're very cost effective, obviously low entry costs, and things like that makes it even more attractive for most people. And obviously the main advantage also is that they said that they're transparent. You can track the value of the investments on a day-to-day basis, either on the newspaper or on the internet. So these are some of the advantages. The disadvantages, they are sold as cost-effective instruments. However, there are other costs involved, relative costs, like initial fees and annual fees and reinvestment costs. So some of these funds will have it, some of them don't have. You must be aware of these things. So when you do your due diligence, make sure you understand the cost structure and things like that. Well, with the investment plan, obviously you can go directly through the stockbroker. You can go through both. As I say, we offer both options as such. When a market is trending, we talk about them in shares, when the market is either moving up or down, it's better to go for index trackers, like the Satrix 40 that tracks the underlying shares of the top 40. When the market's moving sideways, it's better to go for actively managed stock pickers. Okay, we'll talk about those just now also. So this is some of the things I picked up when I've done my research. The disadvantage also when it comes to, especially with ETNs, remember with exchange-traded funds, you receive a dividend. With exchange-traded notes, you don't. There's no dividends involved. A gold note, a gold ETN doesn't pay any dividends or interest. So those are some of the disadvantages as such. So let's talk about exchange-traded funds in more detail. Okay, as I say, similar to unit trusts, open-ended, you buy into a basket of shares. They track a wide range of instruments. You can either go for actively managed growth portfolios or fixed interest portfolios or optimum mixed asset type portfolios. So you can mix and match. Okay. And the main idea is that you understand that although ETFs are passively managed, the shares that make up the respective funds are traded actively on a daily basis. So, you don't have to wait for the end of the day to see the value of the fund. It's straight away. And we'll talk about the calculation of the NAV just now. So it offers you exactly the same benefits as normal share trading. So remember, these things are valued at prevailing share prices, market prices, and it can be redeemed at any time. Okay. And also, obviously, the dividends and interest are automatically reinvested. We talk about a total return index. That's what we talk about. Those funds, or any distributions are reinvested. So obviously, that also contributes to the growth of the underlying. Okay. So they're cheap. Okay, the safe way for investors to get involved in the local market and international markets. Okay, what I found interesting when I was doing my research, I found that only 20% of unit trust beat their benchmark indices. Okay, it's over the last 1 to 7 years. And it gives a strong argument for investors to consider passive investment like ETFs. However, just be aware, I find, the more I look into these things, I think it's more for the a more knowledgeable investor. You need to understand how the market works, because these things, obviously, some of them are specialized. You have to understand the supply and demand, especially when it comes to commodities and things like that. Whereas, you're buying into Satchix 40, you're talking about one share going to 40 shares, okay? But the underlying basket is 40 stocks, or you might go into the financial 50, which is only 15 stocks. Where some unit trusts will be more diversified. So the perception is that some unit trusts obviously will have a lower risk, okay? So again, do your homework when it comes to these things. As of December last year, there were 38 ETFs. Remember, they're registered as collective investments. And the biggest fund by far, you'll see just now, is New Gold. It's more than 20 billion. So it's quite big. Remember, that's the biggest fund, whereas Satchix was the very first one that was listed. That's only 190 million. That's a market capitalization. ETFs, at this point in time, only represent about 4% of assets under management, okay, in the collective investment industry. So there's a lot of growth potential. And I think as more people get involved with these products and more people get to know about them and talk about them, obviously there'll be more scope also for improving. Okay. So let's talk about how are the price calculated. So the ETF's underlying net asset value, similar like with shares, is calculating by taking the current value of the fund's assets minus all its liabilities, and that's divided by the number of shares in issue. So that NAV value is published every 15 seconds to the market. Okay, whereas a traditional unit trust, that NAV is only set at the end of the day. Okay. However, that ETF's NAV is not necessarily its market price, because remember, there's still supply and demand. Buyers and sellers going to the market. Buyers will push the price up, and sellers will push the price down. So the market price can differ slightly to its NAV, but the way these things are structured, it keeps that gap very, very tight. Okay. By the way, you must also excuse all this. There's a lot of texture. Obviously, when you get the PowerPoint presentation, you'll be able to read it. That's why I'm going through this very fast. Okay. But as I say, excuse all the text. The advantages, price determination, it can be bought and sold intraday. We've spoken about the liquidity. What's nice about this, as I said, is suitable for the DIY approach, but for an investor that knows what he's doing. Okay, so you don't really need a financial advisor. However, you still need to know the product knowledge, understand how the market works and things like that. Okay, ETFs purchased directly, okay, do not incur management fees. So if you had to go buy directly from Deutsche Bank and things like that, there won't be any management fees. Remember, I said there's no securities transfer tax on ETFs and ETP because they're considered collective investment schemes. So what's nice about these things also, it gives you, as I say, the more advanced investor, an easy way to express a macro view. So it makes easier investing simpler and easier as such. Okay, you might want to hedge in the market. You anticipate that a particular share or sector is going to fall. All you do is you do the opposite. You do the opposite exposure. So you anticipate that resources will underperform. You sell the resource shares, okay, and you buy ETF on the broad market. So in other words, you're hedging against the overall market movement. So that's how you can start structuring a share portfolio in that way. Okay. We spoke just now about the ETFs costs and things like that. And as I say, one of the other things we must be aware of, that these things can what we call cause bubbles. We talk about the funds being channeled. So, for example, the gold price ran, and obviously the rand price of gold is running. Everybody rushes into new gold, gets to the stage where it becomes, like, as I say, a bubble, and that can lead to short-term market stability. So this is one of the fears out there regarding ETFs. So it is a time and place for everybody's portfolio, but again, you need to understand the advantages and disadvantages before investing. Okay, so let's talk about the style or the kind of the categories we have available in South Africa. Okay, sorry, I'm just looking at. Okay, You can say this loosely grouped into index tracking ETFs that broadly, for example, some of them might be tracking the top 40 shares, some of them are more sector specific. There are bond or fixed interest ETFs, floating interest rates, property ETFs. Then we talk about the smart ETFs or the style ETFs, multi-asset or balanced ETFs, and then the foreign exchange, foreign ETFs. And there's also a range of what we call fundamental ETFs and commodities. So these are just some of the broad categories. So there's a whole range. Remember, there's more than 38 to choose from. So we're going to go through these very quickly. Just explain what these things can do. Index tracking ETFs, as the word implies, it tracks the index. So it reflects the performance of an underlying index, or the index as such, the top 40 index, or the industrial 25, financial 15, and so it goes on. There's two property ETFs. But the main selling point is obviously for most people is the cost. So bond ETFs, as we would apply, it obviously tracks the government bonds. We'll be going into more detail just now with them. Smart, this is where the market's moving towards, where this is value add. Markets, the trend is moving towards what they call smart passive funds. So they're not only tracking the underlying index, okay, they look at other factors. And I use the example here of the Satchix Divi. Now, the idea here is that they use a consensus, and they look at the consensus from the industry analysts. They look at the top 100 shares, and now identify the top 30 companies going to be paying out dividends. Dividends this year with the highest potential. So you're focusing on high dividend yielding shares, but someone else is doing the homework for you. That's what we're talking about when we talk about smart ETFs. And we'll go into some detail just now. Balanced or multi-asset ETFs, obviously you're spreading. This is all asset allocation. You want to diversify your assets between equities, bonds, cash, and money market. It's a bit more of a prudent approach to the market. But the idea is that you want to diversify the assets. You want to have all your eggs in one basket. They are much cheaper than normal unit trusts, on average about 0.8%. Whereas unit trusts can charge up to 2%. So as I say, the cost is one of the major attractions for these ETFs. Foreign ETFs, Deutsche Bank has the majority here. We'll go into more detail just now. So you can have exposure to Europe, the UK, the United States, Japan, alternatively world markets just through one ETFs. And we'll go into more detail just now. So let's talk about the providers. There's 8 ETF providers at this point in time. Absa Capital are the biggest, whereas Satchix is second. So what gets tricky with these ETFs is that each ETF provider calls the ETF different things. So obviously Satchix is one of them, New Funds is another one, and so it goes on. So let's talk about Absa Capital. As I said, they have 15 ETFs at this point in time, and they also have a few ETNs. So we've spoken just now about New Gold. It's got a market capitalization, I'm sorry to get my little highlight here, market capitalization of more than 20 billion. Now this information I got from Funds Data, which is part of Profile Media, Profile Data. But what's interesting about this, here in South Africa we know that the troubles on the mines regarding the mines are old and deep and obviously labor problems, etc. But you want to have exposure to gold, instead of having to go buy physical Kruger Rands and you have to worry about keeping them safe. Yeah, you can have the exposure to gold. It's actually a rand price of gold, and it's the equivalent of a 100th ounce of gold bullion. So that's usually your exposure to it. Obviously, the disadvantage is you're not getting any dividends, you're not getting any interest as such. There is a cost involved. There's an annual fee of 0.4%, obviously for that safe custody. There's also it's interesting to note that New Gold is considered one of the best performing tracker funds over the last 2, 3, and 5 year periods. So I believe that this should be a part of anybody's investment portfolio, allocate a certain percentage to gold. So those are opportunities. This is how it's been performing since inception. Okay, 2005 until now recently, 418%. So as I say, imagine if you got in a run in the beginning, obviously with the gold price and things like that, with the rand getting weaker, imagine that kind of kicker in your portfolio. Yes, let's talk about some style. Those ETFs I was talking about earlier on. Absa's got a thing called New Funds, and in this situation here, we talk about the momentum ETFs. Now, what's the idea here? It's a process that they filter looking for the shares that's going to go into this fund. They use what they call relative price momentum, and obviously they're given different weightings and things like that. And then it's filtered further by market capitalization and liquidity, and then inflation adjusted, and then filtered again based on relative momentum. So then the shares are ranked in descending order, and they choose the top 40 stocks from that. So, as I say, using someone else's expertise to choose the basket of shares to get involved in there. New Rand, by the way, New Rand market capitalization of 83 million. This tracks a basket of the top 40 Rand hedge stocks. Now, until about a week or so ago, the Rand has been underperforming or been weakening. You should have been exposed to Rand hedge stocks, and this is one way to do that. Through one share, you have exposure to the top 10 shares. Obviously, that would be financial resources and the industrial shares. And obviously, the last few days, the market has pulled back, or the Rand has pulled back. It's strengthened a lot, so it has been hurt. But maybe it's a trading opportunity, investment to get involved now. New South Africa, this tracks is BE. I talk about BE shares. You're tracking the modified top 40 index, and that's based mainly on companies of Empower ratings. So you go for your black chip shares and things like that. And then they also have a range of what they call Sharia. This is looking at the Sharia compliant shares, and obviously this is applying to the Islamic community as such. So it's different ETFs catering for different investor needs as such. Obviously, when I talk about Sharia compliant, you're investing in the companies that are not alcohol or tobacco or gambling orientated or involved in those kind of activities. So that's what they exclude, those kind of shares. You can see how New Rand has been performing. Remember, this is the Rand hedge stocks. This is from 2003, from the low to this high here, or the recent close, 248%. Okay. New South Africa, this is the BE shares, 104% up. Okay. Now let's talk about the fundamental ETFs. Now I find these also interesting in the sense that they are chosen using a methodology that weights the shares based on certain fundamental criteria. So we talk about sales or turnover and the cash flow and book price and dividends. And then they go again, they screen through that list again, and they look at the quality of the earnings. So looking at the consistency and the safety of the earnings as such. And then they also look at a whole lot of other risk factors. And from there they rank, and then they choose the top 40 companies. Okay, so that's what we're talking about when we talk about the overall ETFs. They do the same thing for the financial 15, the top 25, and the industrials. You're using fundamental analysis to choose the shares. Again, they say it's a form of style, but they're using, you can see it's trademarked. Obviously, there is a management fee for this. You pay slightly bit more for this so-called expertise. You can see also how they've been performing. This is the overall market. This is the financials, the financial 15. That's the industrials, and resources haven't really got anywhere. But it's just looking at various ways of starting to structure a portfolio using these kind of ETPs, the ETFs. SWIX, everybody talks about SWIX. All it is now, you're looking at a shareholder weighted. We're looking at the share register of the company, and then it's adjusted for cross holdings and things like that. The idea is to reduce resource or delisted shares. And that's obviously one of the risks involved if you want to buy into a SATX 40, for example. Very much skewed towards Rand hedge mining stocks. And what happens, the Rand gets stronger, obviously it gets pulled back. So this is the kind of thing you want to look at, is we take that out. So it gives you that exposure. There's a lot of other little funds you can look at from in the Absolute Capital Fund. This is the SWIX, so the performance there. Obviously, when it first started out, there's a lot of uncertainty of it, and as the market got used to it, there's more liquidity. You see, not so much flatlining going on at the moment. But remember, we spoke about liquidity just now. It's one of the criteria when you're looking at choosing a share, choosing a fund, look at liquidity. When there's flat lines like this, these are times where there's not much activity happening. So you're stuck. You won't be able to find a willing buyer and seller. So remember, take that in consideration. This is the Govy and the ILBI ETFs. You can see their performances. By the way, you can get all the fact sheets, as I say, on the Funds Data website. I use it personally for myself. You can subscribe to it, and it doesn't cost a lot of money a month, but it's worthwhile. This is a interesting one in the sense that it tracks money markets, the 3-month and the 6-month and the 12-month rates as such. You see that nice little performance, steady income coming in all the time. APSA has this thing called MAPS. Basically, I like these things in the sense that they are lifestyle, if you were to call it lifestyle ETFs. So it's asset allocation based on your different stages of life. So the growth fund is obviously more for the a younger person, someone with a longer time horizon, but also they're compliant to what they call Regulation 28 of the Pension X Fund. Okay, so it's more for the younger guy. Okay, this is a longer term horizon, whereas the Protect ETF is more for the to someone that's closer to retirement, someone that's got a lower tolerance to volatility. And obviously, someone that's looking for a stable return income stream, okay, return capital stream, and obviously income. You can see how they've been performing. They've only been around for about 2.5 years now. It's steady. Obviously, you're looking at a longer term view, so maybe something to look at. Okay, Deutsche Bank's. These is where we talk about our offshore funds, and again, you can go to Deutsche Bank's website to understand more about these things. So it's a nice way to start taking your money offshore, or having exposure offshore, rather. You're not taking your money offshore because it's all it's still rand based. So you can have exposure to the top 50 European stocks, the UK market through the FTSE 100, Japan. Okay, you're talking about 400 shares in Japan on the UK on US markets. Talking about 600 shares. Alternative, you can also go for the world ETF. Now you have exposure to 1,900 shares worldwide. Okay, so there's various funds to look at and to take exposure if you want offshore exposure, especially with things starting to look up now. Maybe it's time to start to look at taking exposure offshore. You see how they've been forming. This is, you can see the moving averages have just crossed. These are all weekly charts, by the way. You can see FTSEs have been up for a while, whereas Europe is still those moving averages have just crossed, so this is what we call the golden cross. Anything above that would be good news. So they've only done it recently. This is Japan, whereas USA done it nearly 2 years ago, and same with the world markets. So this has got a lot to do with recently the rand weakness. Obviously, you can see the rand has pulled back slightly, and gives you the buying opportunity to get into the market then. Investec has only one ETF at this point in time. It's a ETF that follows the government bonds. So what it is, it's when we talk about a total return index, it assumes all cash distributions, be it dividends and interest, that gets reinvested automatically. Okay, so this you want to have exposure to government bonds, maybe as part of asset allocation. Maybe you want to consider Investec's fund as such. You see how it's been performing since 2008, not too shabby. So something to look at. Then Nedbank has got 3 different ETFs, which are also quite interesting in the sense that they've got the beta. We're talking at the top 40 stocks, where they are divided proportionally by 2.5% per each. So the asset allocation is 2.5% to each. So they're all equally weighted with 2.5% in each. So they're rebalanced every quarter, obviously to mirror the underlying constituents of the top 40. Then they also have we call a green ETF. This is for the people that are concerned about climate change issues and things like that. So obviously, you're investing to companies that are involved in climate change issues and also are performers responding to climate change. And so there's quite a few companies involved here. It's only been around since 2011. So the fund is spread between 23% financials, 22% resources, and 55% allocated to industrial shares. Okay, they have a prefix. This is also for someone that wants exposure to the sector, preferential shares. So you're getting a capital growth plus the income. So obviously for someone that's it's paying a high portion of income tax on interest income. So it's ideal for the retirees, or high net individuals. So someone is looking for exposure to preference shares. Remember, there's another asset class. You get ordinary shares and then preference shares. So this is mainly looking at income, something to consider. To see how the three funds have been performing, the preference shares may be underperforming and might be turning around soon, whereas the other two are about to top down. Okay. Prop tracks, these are the two property funds. The top one, the first one here, this was the very first one listed in South Africa. Obviously tracks the top 20 listed property funds. So that's ideal for the novice investor as such, whereas the top 10 is there's equal weighting of 10% in the 10 funds as such. So it's also rebalanced equally. They've been performing very, very well. We can talk about 47% for the SAPI, whereas the 10 PropTex 10 is roughly about 37%. So you want exposure to property, something to look at. RMB, you know, what I find interesting, yes, there are a lot of funds tracking the top 40. RMB has a fund called the RMB Mid Cap Exchange Traded Fund. Obviously, we're following the next 60 companies in the top 100, so from 41 to 100. So we're looking at all companies. Okay, I understand that there might be some connection issues. Okay, hope you guys are hearing me loud and clear. Okay. Okay. So I got a message that popped up about the connection issues. Some of you guys might be experiencing connection issues. So let's talk about the SATX 40. Well, the SATX group of funds. There's quite a few of them been around. SATX 40 ETF. So the market capitalization, the size of the fund is 190 million. It accurately replicates the top 40 index. So it's exact weighting and a number of shares in each fund. It pays its dividend on a quarterly basis. You actually receive the dividends. You don't actually have it reinvested. You receive it on a quarterly basis. So those are some advantages. Some people might want to consider receiving the actual dividend. Where the SWIX, as I say, again, it's the shoulder one, where we're taking out resources and dual listed shares. You see how the SATX has been performing? I like this as my core portfolio, and then I bought satellite shares around it. 359%. Obviously, we understand most of the shares in this fund are rand stocks, resources, and mining. So you might consider the SWIX, where it takes that out. You can see it's only been around since 2006. It also was impacted by the credit crunch in 2008, but we're up from the start till now. We're still up nearly 81%. SATX Funny, SATX Indy, and SATX Resi are self-explanatory. You see how they've been performing. Obviously, SATX Indy been outperforming the SATX Resi by far. Resi obviously has got a lot to do with economic growth, commodity style investments. So they've been moving sideways for nearly 3-4 years. So you can see the Indy's outperforming. So let's move on to the Divi. I find it also interesting in the sense that it's got a bit of a defensive structure to it, in the sense that it's got a lower correlation with other indices. So it's a great way of diversifying your portfolio. This is where most of my funds are for my children's education, and the SATX Divi. So you see how that's been performing. So it's not too shabby. I like SATX Divi quite a lot. The RAFI, we spoke about the fundamental factors just now. So obviously we look at dividends, cash flow, sales, and net asset value, and obviously the dividends are reinvested. Okay, you can see how that's been performing. Let's move on quickly. How do you pick a ETF? There's 4 things you can look at, and this I got from Investopedia's website. The level of assets, obviously, the company's been around for the longest will have the largest capitalization. Obviously, it'll have the greater degree of investor interest. Smaller funds, just started, will have a lesser degree. Obviously, that can also affect liquidity and also the bid-offer spreads between the buyers and sellers. So that's something to consider also. Volume, very, very important. We spoke about it just now. Also helps with liquidity and tradability. And it also depends on the underlying assets. What are we investing in? As I say, you have to do your homework. So you might want to go for a broad diversification, or you want to be focused on a specific share or sector. So you need to decide for yourself what you want to be. As I say, the big thing is first mover to market, the SATX 40 and things like that, grabs a market share. Where else? Everybody else follows after that, becomes a copycat. There are a lot of imitations on the SATX 40. So you need to differentiate for yourselves. Only later on will they get more and more interest from other investors. So that is very broadly, quickly on exchange traded funds. Let's go through exchange traded notes. Now, there's a big difference here in the sense that while they might share the same characteristics, they differ in structure. Okay, where they both have low market entries. Okay, ETNs are debt instruments. Now, a lot of people will shy away from this straight away, or I'll stay away from debt instruments, number one. Whereas ETFs are equity instruments. Okay, ETNs do not pay out dividends. So that's what you have to look at, pros and cons. But you want to be involved with someone that's going to be around for a long time. So it all depends on the solvency and credit rating of the issuer. So you have to say to yourself, gee, what's the chance of ABSA or Barclays Capital going bankrupt and that kind of stuff, or a Standard Bank, whatever the case might be. So remember, the big difference, they are not collective investment schemes. However, securities transfer tax is still not, they're exempt from securities transfer tax. Okay. So they're effectively debt products, similar to bonds. There's a credit risk. That's something you have to consider if the issuer defaults. And there's no guarantees on the principal. If something goes wrong with the supplier, you've got no recourse as such. So those are the kind of things you have to be aware of. So a lot of people are staying away from it because of those kind of things. Okay. However, they're still very cost efficient and highly liquid. They're still very convenient, and they still represent the basket of underlying assets, all other advantages and things like that. And also an opportunity to diversify your portfolio further. So let's talk about some of these ETNs. There are 22 available. So there's 38 ETFs and 22 ETNs. So you've got 60 products to choose from. Again, the banks, obviously, these are all through the big banks. Standard Bank's the biggest in the sector, and then followed by ABSA Capital. So let's talk about ABSA Capital. They've got 5 different funds. Now, this is nice for someone with exposure, for example, to currency. Okay, so they have 3 different currency ETNs, whereas, for example, the ETN, the euro, you have equivalent of €1. So one ETF is equivalent to €1. So you want to go buy 100 ETNs, obviously it's €100. So you're getting access to that. It's like putting your money into a euro bank account. That's what you're looking at. Okay. You do get interest on it, but obviously less costs and things like that. But the dividends, or the interest rather, is distributed on a semi-annual basis. Remember the SATX 40, for example, was on a quarterly basis. This is semi-annual basis. So euro, the ETN is equivalent to €1, same as the British pound, and same as the dollar. So you can see if you look at the graphs, very similar, the rand exchange rate. Okay, here's the euro, we're close to 12 rand. Here's the pound, we're close to 13. And here's the dollar, very close to the 9 rand. Okay. So if you want exposure to currencies without taking money offshore, this is the way to look at it. If you want to get involved in platinum, remember there's a gold. New gold is the most popular gold ETF, whereas ABSA has also got a platinum ETN and a silver ETN. Okay. Remember, it's in rand. Okay. It's a listed instrument, but it's based on rand. It's 100th of an ounce of platinum, and same with silver. So those of you that believe that silver is going to go through the roof, you want to have exposure to silver, these are the things to look at. They're called new waves. As I say, each provider calls these things different things. So you can see how they've been performing. Silver has obviously been underperforming slightly, bit of a down channel if you look at that there. So it might break out of it soon, below those moving averages. Still, it's oversold. You might consider getting to silver at this point in time. Deutsche Bank, apart from the developed market ETFs, they also have one on Africa, on China, and also on emerging markets. Now, I find this interesting in the sense that you can go a bit further and say, okay, gee, I think there's growth opportunities in China. So yeah, you're looking at shares listed on Shanghai, the Shenzhen, and the Hong Kong Stock Exchange. So through one share, you're getting exposure to all those shares. What I also find interesting is Deutsche Bank has this emerging markets index. You have exposure to 21 emerging market countries, okay, from Poland and Russia to South Korea and South Africa, Thailand and Turkey. So 21 different countries that you can get exposure to. Okay, you can see how they've been performing, not too shabby. Again, as I say, something to look at. Where New Gold follows the rand value of gold, Investec has a gold exchange traded note that tracks the physical spot gold price, okay, in dollar terms. Okay, so there's no that exchange rate exposure and things like that. This is what they call quanto, in the sense that a similar move in the underlying share will be a similar move in the ETN. So you don't have to worry about it. So that exchange rate risk as such, you don't have to predict what's going to happen to the dollar. It's going to get weaker or stronger and things like that. Whereas in the past, the rand and gold price has always had this negative correlation. When the gold price rises, the rand strengthens, vice versa. This eliminates that. So those of you that want to maybe trade a quanto, we get quanto commodities. Here's a quanto ETN. Another benefit of this, at this point in time, there's no management fee for that. So nice way to look at it. So where New Gold has been flying because of the rand, ETN in this situation has been going down because the gold price has pulled back. Remember, gold has been acting like a currency. The dollar's getting stronger, so there's risk aversion. So people move out of gold, they move into dollars and things like that. So where gold has always had a safe haven aspect, people prefer the dollar as such. Okay, that's what's been happening here. When the dollar gets weaker, people move back into gold. So this is showing the opposite to gold strength, actually dollar strength rather. And obviously, Investec has a Swix and a top 40. As I say, those are the ones that are the imitators, come to the market afterwards. Grand Merchant Bank has two ETNs, one on coal, another one on oil. Yeah, you're following the Richards Bay Coal Terminal, the futures contract there. It's still rand denominated, so those of you who want to have exposure to coal, something to look at. They also have one on oil. So you can see how they've been performing. Okay, again, you see that some of these things sometimes are flat. So there's some liquidity problems here. So remember to take that in consideration. Here's the oil one. Obviously, oil price has been bouncing around $105, $106. So you want exposure to this. This, by the way, is not the Brent crude oil price. This is the light sweet crude. Okay, so different kind of oil we're looking at here. Standard Bank has a range. They've got 9 different commodity funds. They have one fund that has a commodity or basket of funds. It's a diversified basket of commodities produced in Africa. We're looking at the average production over the last 5 years, and obviously adjust for risk and things like that. So that's what it looks like. This is the basket commodities ETN, whereas they have a range of other, what they call linkers. And as the word explains, obviously there's commodity, there's copper, there's palladium, platinum, and silver. Also, I find interesting they have one in corn. Those of you that want to get more involved with agricultural, on the agricultural side, the farmers and things like that, there's corn and there's a wheat. So you can see how the oil one's been performing. The other two agricultural ones. He has the corn and he has the wheat. So again, they're still very newish. You see there sometimes there's flatlining. So obviously, as more and more people get involved, there'll be more liquidity, more activity, more liquidity coming to the share. So, how do you choose an ETN? again, when I did my research and things like that, I found some simple steps. Keep it simple. You know, we can get all complicated when choosing these things. Main idea is to do your homework. You saw there's quite a few different ETNs, commodity ETNs. There's pros and cons of each one of them. The main thing you're looking for again is liquidity and things like that. Also, obviously, the costs are important. So I suggest is analyze it. Go look at those fact sheets on that funds data website. Look at the performance, and then obviously pick the ETNs of a strong performance record. Okay, you want to see one that's been going down and down for the last 5 years. Number one, performance, and number two, you want to go for the one with the low fees. So it's very easy and simple to put a fully diversified portfolio together by spreading your funds across, say, two or three or so ETNs. Especially if you believe in the commodity cycle. A lot of people say commodity cycle is coming to an end. So those kind of things you have to take into consideration also. When it comes to investment strategy, you know, combine ETFs with shares, with unit trusts and things like that. I use ETFs in one of my portfolios as a core portfolio, and I have satellite shares around it. The idea is that, I'll use an example, this would be my SATIX, the divvy, and then I've got high yielding, dividend yielding shares around it. So just a way of building a fund up, it's going to grow. That's one investment strategy. So you've got your core and you've got some satellites around it. Okay, obviously you're allocating more funds to the ETFs and lesser funds to each individual share. Obviously spreading the risk there and diversifying a bit further. So that's just one investment strategy. There's various ways of looking at it. Okay, so quick summary. Obviously, exchange-traded funds in ETFs give you more choice, give you more control, more protection of your portfolio. However, okay, in conjunction with your overall investment strategy and your goals and preferences, you must take into consideration that it's not for everybody. So it's more for an advanced investor or trader. So remember, you can either go through the PhD Online trading platform or the investment plan. It's great for someone just starting out, hasn't got a lot of funds, put the money aside on a debit order, for saving, build up the capital, and from there, obviously, go a bit further to other investments. So you're beginning this presentation. Everybody that's on this webinar, I'll be emailing you this presentation soon. Please read through it again. You'll pick up a lot of information there. And also, you'll pick up a lot of information on our PhD Online website. A lot of information from this presentation has come from our website. And those of you that are based in Durban, just a heads up quickly, I'm coming down next week, Wednesday. We have our first Traders Forum ever in Durban next Wednesday evening. Remember, the forum is the idea is a forum where we discuss the market. So we talk about in some shares, be it from a trading point of view, investment point of view, and the idea is that we're looking for tips. And I want to find some tips from you guys in Durban too. Next week, Wednesday, from 6 o'clock to 8 o'clock, please go to the website and book. Then our next webinar is scheduled for 2 weeks' time, on Wednesday the 24th, and there I'll be discussing fundamental analysis. I'm going to go through the balance sheet, the income statement, and the cash flow statement. You can look at various financial ratios. Okay, how is the PE ratio calculated and the return on equity? We look at various financial ratios, and then we're also going to look at various valuation techniques. But we're going to be concentrating on fundamentals. So again, just go to the website and book a place. So from my side, lastly, is good luck and happy trading. Let's see if I can tackle any questions here. Just bear with me quickly as I just move back to my, see if I can answer any of these questions. Whoops. Okay, that's make it bigger. Just bear with me quickly. Okay, Dieter Ralph, hello. Okay, can one sell ETFs short? No, remember these are not derivatives. You can't go short. These are, this is Vickers. So you can go, oh, sorry, okay. You can go use single stock futures on SATIX 40 and things like that. Yes, they are part of the top 100 shares. It's mainly the SATIX stocks. I think there's about 3 or 4 of them there. So So the SATX 40, the SATX Indy, SATX Finny, the free dealing liquid ETFs you can go sell short. So it's another way of looking at trading an all Z or all me. You can use the SATX 40. So Vickers, to answer your question, yes, you can sell the SATX products short. This is another question from Vickers. Does one need to trade via other suppliers as an absolute to trade the ETFs, or can one use a PSG? As I say, you can use through PSG announced platform. You have access to the 9 suppliers instead of just going to APSA platform or buying directly from APSA Capital. Yeah, you got flexibility of trading all 9 suppliers. So Vickers, I hope that answers your question. I don't see any other questions coming through. Vickers, pleasure. So yeah, I will be sending this presentation out to you guys. Any questions you have, you're welcome to email me again. Here is my email address, if you guys can see that. There's my email address, seanvdb@psgonline. There's my direct phone number. Regarding anything we've spoken about today, ETPs and covering ETFs and ETNs. Yeah, so from my side, thanks for your time. I hope you've enjoyed it, found it useful and beneficial. We'll talk to you guys again. Thank you very much for your time. Enjoy your day. Whoa, there's a question coming in. Not a question. Interesting topic for development. Okay, that's from Paul. Okay, good. Pleasure. Any other questions coming through here? Great. Guys, thanks a lot, and enjoy the rest of your day.